Hello, I'm Charlie Oppler, 2021 President of the National Association of Realtors. Welcome to NAR's first Global Real Estate Forecast Summit. We're honored to have so many colleagues from around the world with us. At NAR, we work alongside more than 100 global partners in 74 countries. Although our partners span countless borders, we share the same commitment to expand international opportunities for realtors, enhance professionalism through education, uphold the highest standards of real estate practice. All three are super important to us. Thank you for being here. I'd also like to welcome the representatives from NAR's 130 global councils who do the important work of building awareness for global business opportunities in the local U.S. markets. And finally, a special thank you to those of you who are missing a good night's sleep to be with us today or tomorrow, in the case of our speakers from Australia and Malaysia. The COVID-19 pandemic dragged the global economy into the deepest economic contraction since the 1960s. With travel bans and business stoppages, global economic output shrunk by 3.3%, according to the International Monetary Fund. But the swift, massive monetary stimulus injected by governments and regional central banks has led us to a quick recovery. Now the IMF predicts the global economy will expand by 6% in 2021. This summit, which brings together some of the most respected leaders in real estate, will help position realtors and their clients to take advantage of the growth here and abroad. From Kuala Lumpur, Malaysia, where it's 2 a.m., we're honored to have Georg Schmiel, co-founder and executive chairman of Jiwai IQI Holdings, one of the largest real estate technology groups in Asia. From Australia, where it's not even dawn on Tuesday, we're grateful to welcome Nerida Conisbee, chief economist with Ray White, which operates more than 1,000 real estate offices across Australia and Asia. Nerida is one of Australia's leading real estate, residential, and commercial experts, and is the most quoted property market commentator. From the Canadian Real Estate Association, we welcome senior economist Sean Cathcart, who oversees the production and analysis of housing market intelligence. But first, we'll hear from NAR's own chief economist, Dr. Lawrence Yun, who heads our research group. Lawrence is one of the most respected forecasters in the United States, and he will now present the findings from NAR's just released 2021 International Transactions in U.S. Residential Real Estate Report. Please welcome Lawrence Yun.
Thank you, President Charlie, for organizing the event. And what a great opportunity to be here. I hope everyone is enjoying the Olympics. And Olympics reminds us of how big the business opportunity across the globe can be, and also how small the world is, where we can make connections, instant communication, find real estate across the globe. And certainly the United States has attracted many foreign buyers. So I am here to present the latest 2021 international transaction here in the US. And it declined, and that should be no surprise given the pandemic travel restriction, and hence that it declined in the past year. But what will happen going forward? Now the vaccination is being rolled out. There's still a great deal of international restrictions, but perhaps there will be some degree of some passport acceptance based upon the vaccination status. And let's just hope that the virus situation steadily diminish over time so we can get back to more normal functioning life. Now let me get my remote control up so I can advance the slide. So let's see what we have. So the map of the world, as we can see, there was only very few countries which actually came out positive economically in 2020 overall. China, they had a major shutdown in the first months of the virus, but then they reopened the economy and they surged towards the year end, and they actually came out positive. The blue color countries, they're all down. So as you can see, most countries were down in 2020. Many people anticipate that many countries were turned positive in 2021. It was at least officially one of the shortest recession, but the depth of the recession was quite steep. So it's going to take some time to get us back up to normal. On the right-hand side, one can see the number of tourists arriving in the US simply collapse. And with this collapse, certainly a major expenditure like real estate will not occur because people want to actually make a physical visit before deciding to purchase on a home. Now, the US housing market, interestingly, even with the absence of the international buyers or major reduction in international buyers, we recorded best housing market in 13 years because domestic buyers remain very strong. Once the lockdown was lifted, economy reopened, consumers were eyeballing record low mortgage rate, and home sales not only got back up to the pre-pandemic, but went way beyond that. Recent months data is indicating that it is no longer that huge surge, but it is still above pre-pandemic conditions. This morning's data on new home sales, which plunged, is implying that there could be some concern that some buyers are saying home prices are simply too high, they're becoming cautious, and also other buyers who are simply saying they can afford home at one price, but not when prices are rising at 23%. So rising prices simply squeezing away some of the affordability for the first-time buyers and consequently a reduction in sales. Now let's turn towards the international numbers. So this is the dollar volume of foreigners buying in the US. We have two categories, dark blue and light blue. Dark blue represent non-residents. So you can visualize a British who wants to buy a vacation home in Orlando. So that is the dark blue, foreigners based in other countries, but want to use US real estate for vacation, or maybe they buy a rental property to get some rate of return. While the light blue is recent immigrants, people who came to the country within the past 2 years. And generally, many immigrants, it takes multiple years to accumulate down savings before buying a home, but there are some recent immigrants who are financially well off and they want to buy a home immediately. So the light blue reflects the recent immigrants who are purchasing here in the US. But both recent immigrant along with the pure foreigners, you can see the reduction. Latest 54 billion compared to 74 billion the year before. And just 4 years ago, it was 153 billion. So essentially you can say today's activity is about 1/3 the level of what had happened 4 years ago. The presence of the foreign buyers overall, given the large size of the US market, so I know in Australia, where we have a speaker where the foreign buyers are much larger presence, but in the US, it make up essentially about 2% of all overall transactions, 1.8% in terms of the actual number of sales, while 2.8% in terms of the dollar volume. The dollar volume is a little higher because foreigners tend to buy more expensive properties. If we look at which countries are coming in, our neighboring countries, Canada and Mexico, were the two most important countries in terms of sending buyers to the US. China was a major force last year or the year prior, but came in third place in the latest. India, many technology companies are hiring the software engineers and the presence of India is at fourth place, while Britain, they are coming in at fifth. In fact, Britain is the only country to actually see a slight increase from last year. But the dollar volume, that big swing that you see on the red graph, red represents China, both mainland China, Taiwan, Hong Kong, and one can see that China was a major force a few years ago, but steadily declining and essentially now coming in third place among the foreign buyers here in the US. Where are they buying? Well, Florida consistently ranked #1 in terms of attracting foreign buyers. We know that many Germans actually like to go to Southwest Florida, near Marco Islands, Naples, that area. British like to go to Orlando region. And then you have many people from South America wanting to go to Miami. I'm generalizing, but generally, you see a sort of larger market share on that trend. California draws many Asian buyers, whether from Korea, Japan, China, because of the more closer destination and larger Asian population along the western states. Texas ranked #3 and no change in position. Texas gets many new business entrepreneurs, like a Toyota plant in Dallas region. So they naturally bring some Japanese business executive who need to buy property. And also given the close proximity from Mexico, there are many recent immigrants who purchase property. Arizona, many Canadians wanting that contrast in weather. So from cold Canada to warm or hot Arizona. New Jersey, New York, the commercial centers are drawing international buyers from all across the globe. This is a little harder to see, but as you can peruse it at the end of this session, because we will have all the PowerPoints available to the audience, but by country, like Canada, where they're buying, Florida and Arizona, again, warm weather states. Then you go to where the Mexicans buying, they're buying in Texas, California, and Colorado. When I was in Aspen, people were saying there are many people from Mexico, super wealthy people buying ski resort property out in Colorado. From China, the close destination of California is a big force, but they're going all over the US, from Indiana to Nevada to Tennessee, where Chinese buyers are looking at. India, they are going to California, Texas, Florida, and from the Britain, you see that is principally for vacation property out in Florida. If we look at the price points, generally foreigners buy more expensive property compared to the US. So comparing from one year to the next, because of the overall more expensive property in the US, you see that the pure foreigners, their typical price was at $331,000, or I should say the recent immigrants, but the pure foreigners who tends to be mostly all cash, they're buying more expensive properties. And then if you look at the very right bar, these are the total buyers of all properties in the US, essentially the domestic buyers, and you see the price points compared now before, but all more expensive in 2021 versus 2020. The cash transactions, the foreigners certainly are more cash than the domestic buyers, but the recent immigrants, which represent the first part of the graph, has been steadily trending down. So I guess in the past, recent immigrants, about half of the transactions were all cash, but now many are taking out a mortgage. Maybe the interest rates are simply too good to give up, so they want to take the advantage of low interest rates. But if you look at the pure foreigners, not recent immigrants, but foreigners, if they need to buy in the US, you would assume they are wealthy or super wealthy, and essentially a majority are paying all cash. Some people did not buy in the US. We have many realtors who work closely with counterparts in foreign countries, or they have many referrals from foreign countries, and some did not buy. We know the principal reason, which is travel restriction and COVID, but what were more long-term reasons? So this is the question that we pose every year, even before COVID. An interesting development is that the key reason outside of the COVID and travel restriction is lack of inventory. When we ask the domestic buyers, they say the same, lack of inventory as being the reason why they are unable to buy. So among people who were not successful, they had an interest in buying, but not succeeding in purchasing is simply lack of inventory. So if we had more inventory, we can get more transactions. The cost of property, some people are concerned, prices have risen better than 20%. So that is also holding back. Some people may be needing finance, and as a foreigners, maybe it's a little difficult to get mortgage, as I shown before, large degree of cash transactions. Let me, for the sake of time, just move ahead. And if we look at the some of the US clients who are looking to buy abroad, it's a small percentage, but people are looking to buy property in Mexico. Maybe the retirees look at more affordable areas to retire. People are looking to Canada. Also, maybe just the family affinity. We have many Chinese buyers buying here, and maybe some, maybe after university study, wants to return to China. So you see the interest in China. Costa Rica, Dominican Republic, again, a very more resort retirement destination. Spain, Argentina certainly provide that affordability. And to just wrap it up, the outlook for 2022 is that the IMF is anticipating the economic recovery. In the US, more home building is expected to take place, which means more inventory choices steadily appearing as we proceed through the month. And in 2022, we don't anticipate superheated market. We hope that price appreciation matches people's income growth. So it could be about 3% growth in the price appreciation. Right now, the dollar has been slightly weakening recently, and maybe this was an attractive draw for many foreigners who wants to buy here in the US. Now I'm going to turn it over to our next speaker, representing Zhu Wei, IQI, George Chanel, who will go into what he is seeing among the Chinese buyers looking to buy abroad.
Thank you. Thank you so much, Lawrence. And thank you also to NAR for having me today or tonight. I want to jump straight into the presentation, a brief introduction, who Zhu Wei IQI are. Our aim is to empower Asian consumers to be global residents. We've historically started as a portal, as zhuwei.com is the #1 portal for overseas properties in China. And I've extended now with a greater reach to cover other parts of Asia. We also have our own realtor group across the Asian markets with 21,000 agents at this moment. As for the buyer group of the Chinese buyers, specifically who are overseas buyers from a US perspective, what are they looking for? They're looking for 4 things. One is education for themselves or for their kids, purchases for investments, purchases for lifestyle, that's where the second home comes into place, as well as immigration. And there's various segments that the ultra high net worth Chinese buyers, about 6 million are high net worth buyers, 57 millions, which are quite staggering numbers, are affluent buyers. And these affluent buyers already buy between 1 or 2 overseas properties. And there's a very, very large middle class in China emerging, which are target for more affordable investment options, including REITs. GDP growth has certainly increased the demand for property. And among Asians, real estate is the preferred asset class for investing the gained wealth. And as a result of that, with the growth of China and the growth of other Asian countries, the outbound overseas real estate investment have grown. Now, looking at the map, how has this changed over the years before COVID to now? The US has bounced back to a very high rank among the overseas purchase destinations. In 2019, it was only #4, which had political reasons to the trade war, and has now come back to #2 when we are talking about the value of the acquisitions. When we talk about the number of the inquiries for properties, it's already number one again. And that is true for Chinese buyers as well as all other Asian buyers, which we can track. Some other countries had also some smaller changes, maybe to only point out that Canada has also moved up. Canada has benefited from the trade war between the US and China on the real estate side and attracted quite a lot of buyers who invested into Canada rather than into the US. Now, talking briefly also about the US in a slightly deeper dive. So as we heard earlier from Lawrence, historically, every year, the Chinese buyers have been the largest overseas buyer group in the US and have dropped down due to COVID and other factors over the last 12 months ending March 21. However, what we are seeing is an increased demand among those Chinese buyers, increase in inquiries among those Chinese buyers, which will lead to further transactions in the future. If we just track where those people are searching, we have to split it into two parts. The high net worth individuals are very keen of purchasing a secondary home, and for them, the classic American gateway cities remain the most popular destination. And you can see them on the right side. It's this circle or this U-shaped form around the borders of the US. For the non-high net worth individuals, they're also looking more and more into smaller, less congested cities, which is a trend which we're seeing in other countries, especially during and post-COVID, where people are moving towards more the regional areas of countries. Also, inquiries, as I said, have increased. You see with the red line, a steep increase in the number of inquiries compared to the previous period. So we do believe that in the quarters to come, we will also see more transactions happening from Chinese buyers as well as from other Asian buyers. Certainly the change in presidency had a positive factor. We've noticed it with the inquiries. And we also feel that because student visas seem to be easier to obtain now, that there's a greater demand now for high net worth Asians seeking also second homes, and that number has grown strongly. The Florida condo collapse had a bit of an impact because people are now cautious in looking towards buildings of that nature, of that age group, because they are facing potential renovation costs. I spoke earlier about Canada and the demand shift towards Canada, which is the fourth most popular destination for Chinese cross-border buyers over the last year and up to now. And what we have seen is there was a strong price appreciation in the Canadian domestic market, which we probably will hear soon about. And that has actually further fueled the demand in kind of a fear of missing out. Now, the interest is very strong in Toronto and Vancouver, and to a lesser extent in the Montreal area. Finally, maybe some tips on how you can attract those Chinese and other Asian buyers. I mean, the internet is definitely the primary search channel, and don't worry if you can't read all these slides are available afterwards. It's important to note, in order to get access to Chinese buyers, you need to be on the other side of the great technological firewall. So you need to operate with players who can get you access there. Language barriers are very, very important because they sometimes lead to domestic leads being preferred over cross-border leads, and then missing out on opportunities. The purchase process with overseas buyers can be a bit longer and slightly more protected. So my advice is create a presence on Chinese social media, market yourself on Chinese accessible platforms, use technology, virtual events and technology. Also read up or hire people, understand Chinese cultures and belief, which is important during the marketing process, and really think and take an open thought on how to market those properties to this very, very important buyer group. If you have any further questions, you can also contact us. So thank you very, very much at this stage for having me. I now hand over to narrator Connie Spee, who is from Ray White, the #1 real estate group in Australia and the region.
Thanks, George, and thank you everyone for having me today. It's very, very early in Sydney. It's about 4:30, but it's such a pleasure to be invited. So today I'm just going to give you a bit of an update on the Australian property market, talk specifically about what we're seeing with foreign buyer activity, and also really what's happening with pricing, because like the rest of the world, we have seen a very, very sharp acceleration in pricing since COVID came about last year. Starting with a little bit about Sydney's pricing. According to Demographia, Australia is the second least affordable country in the world. It's based on a multiple of income to house prices. It comes in second after Hong Kong. So it is a hugely expensive country. In terms of, I was going to give you a chart and just show you on a chart, but I thought maybe just giving you some examples of how expensive Sydney is. If you have a look there, a property, both of these are derelict properties, one of them in Freshwater in Sydney, so a pretty nice suburb just north of Manly, for those of you familiar with Sydney. That sold recently for $3.2 million. In Blacktown, really far from the city, 43 kilometres from the city. It is Sydney's highest crime suburb. And you can see there a very rundown property for $1 million. So it's, you know, there's no doubt that there's a lot of affordability issues that really come about. And these have become particularly pronounced over the past 12 months. In terms of pricing and what's happened with COVID, COVID has turbocharged house prices. They have increased by 15.6% across Australia over the past 12 months. Not as strong as New Zealand. We also are the biggest real estate agency in New Zealand. And in New Zealand, prices have increased by 22%. So that market is very similar to Australia in terms of what's happened with pricing, but far more accelerated than what we're currently seeing. Some of the drivers, you know, these are again pretty consistent with what's happened elsewhere around the world. We do have record low interest rates. We've got very, very high household savings rates. Household savings rates actually doubled during the COVID period, during particularly 2020. We've had a lot of government incentives put in place, and these have been really, really generous, particularly for first home buyers. And then, of course, we have had that incredibly strong rebound in the economy, and Australia's GDP is now back to where it was prior to March 2020, and we are continuing to see very, very strong growth. The cities most impacted, you can see there, Sydney hit a $1.26 million median. Prices jumped by nearly 20%. Hobart, a very small city down south, also saw very strong increases. And then Perth and Darwin started to see increases, primarily because we have seen a very sharp rebound in iron ore, and that is being driven by the Chinese economy seeing very, very strong growth. So Australia's economic growth is highly dependent on Chinese economic growth, and at the moment, in particular, iron ore exports are contributing significantly to our economy. My thing just came off. In terms of some of the trends that have occurred during COVID, one of the big ones really was a shift to regional Australia. We did see the biggest shift that had ever been recorded. There has been, you know, decades of policy designed to try and get people out of expensive capital cities and into regional areas. It hasn't been that successful, and it took COVID really to get people to move away from capital cities to regional areas. There's a few things that are driving it. Part of it's lifestyle. People have changed the way that they've worked. They've saved a lot of money. That we have seen very strong demand for second homes. Byron Bay has been the strongest performer in Australia. We have seen that jump by 71%. Prices jump by 71% to hit a $2.5 million median. Mining, as I mentioned before, is leading to some very strong conditions in Perth and also Darwin, both biggest cities. But when you have a look at some of the smaller regional towns, we've also seen some pretty major jumps. And then, of course, agriculture has also done well. So It is obviously a major part of the Australian economy. It has done well because we did see a break of the drought, particularly in New South Wales, Queensland and Victoria, but also adverse conditions elsewhere. Wheat in particular, I think our major competitor is Russia, and I think they were hit by some pretty bad weather last year. So that was good news for our wheat production. So there's lots of factors, but that's probably one of the biggest outcomes from what's happened with COVID, very strong price growth. We've also seen some very strong pricing at the luxury end of the market. So when we have a look at how many suburbs have now exceeded 3 million over the past 12 months, that's increased significantly. What's quite interesting about the luxury market in Australia at the moment is that it has changed. The buyer demographic has changed quite significantly. So it was driven by primarily people employed in mining or with mining businesses, also property. A lot of the really high net worths in Australia have been are in the property industry. This time around, though, a lot of the buyers are a lot younger. So we are seeing a lot of younger millennial buyers being able to purchase some of the ultra luxury properties, but also tech industry. So, again, pretty similar to elsewhere. Tech has done very well through COVID and has allowed some of our best performing tech company owners to purchase some of these very, very expensive properties in Sydney. In terms of foreign buyers, Australia is highly restrictive as to what foreign buyers can purchase. We only allow foreign buyers to buy new property. It is designed to try and create more housing supply. So we do have very big restrictions on foreign buyers purchasing existing property. A little bit different from New Zealand. In New Zealand, they have put a complete ban on foreign buyers, and a lot of it was really driven by what happened in 2015 and 2017. We did see this enormous flood of money coming out of Asia. It did a lot for housing supply. I think that's something that a lot of people miss, is that it actually did create an enormous number of apartments, particularly in a Melbourne, in a Sydney, and in a Brisbane. But it did create a little bit of angst as to what it did to pricing. And we did, not only did we have a big foreign investment boom at this time, but we also saw a local investment boom as well. So it did hit record highs in 2015, 2017. A lot of buyer activity coming out of China, and a lot of the purchases were in high development areas, CBDs, and particularly located close to universities. So we do find that when Asian buyers look to Australia, they do tend to focus more on education, particularly places like Carlton in Melbourne, Clayton in Melbourne, places close to St Lucia near Brisbane University. So that is quite unique. What we're finding now is that the level of investment coming from China is a lot lower. I mean, it is partly to do with the fact that people can't get into Australia at the moment. We do have locked borders at the moment, but also because of a lot of restrictions that were put in place after 2015, 2017. Additional taxes were put in place by a lot of state governments. So it became far more expensive for offshore buyers to buy property over that 2015, 2017 period. Hong Kong buyers are still very active, and also expat buyers are also active. So we have seen a lot of expat activity, particularly people keen to come back to Australia because of, I guess that because we have had so few COVID cases and because the economy is doing pretty well. When we have a look at where overseas buyers outside of Asia look, we do tend to see people looking at places where there are already a lot of people from that country. So UK buyers looking in Manly, US buyers looking in Byron Bay. That's been a bit of a change. That was previously Mossman, but that has changed. And it is a very consistent link. So you can pretty much look at the census and see that whatever suburb has a very high proportion of people born in that country, we do tend to see a lot of buyer activity follow through from that. In terms of just the final slide, in terms of the outlook, we are continuing to see price growth accelerate. One of the interesting things that's happened over the past 3 weeks, or about probably the past month, is a lot of cities have gone into lockdown. So here in Sydney, we're now 5 weeks into a lockdown. It is harder to buy and sell property. We have to restrict open for inspections to one person. We can't do auctions. Auction is a big way of selling property in Australia. So we've had to move to online auctions. In Melbourne, you can't even do an open for inspection. So you do have to, the only way to inspect a property is to look at it through digital video of the property. So there was, a little bit of hope that price growth would start to calm a little with a lot more properties for sale. But what we are seeing is, because it's harder to transact, the number of properties is starting to reduce again, which will probably lead to an even sharper acceleration of pricing over coming months. Interest rates, everyone's watching our inflation number that comes out on Thursday very closely. We have started to see mortgage rates creep up a little bit. So that, again, was a hope that it would start to calm the market, but they're not moving quickly. We're not seeing variable rates really change, but we have fixed rates, which have a 5-year time period. They have crept up a little bit. There are a lot of challenges now, or a lot of concerns about Fortress Australia. We are a country that does rely on international migration. We have a lot of problems with rolling lockdowns, and these can happen very quickly. That business as usual, and then suddenly we're all locked down, and people have to adjust themselves personally, but also we do find it quite challenging for buying and selling property as well, because a lot of the legislation does change. So migration is a problem. Also, foreign buyers, we don't really expect them to come back anytime soon, primarily because it is very difficult to get into Australia. So thank you for having me. It was really a pleasure. And I'm going to now pass on to Sean Cathcart, and he's going to run you through what's happening in Canada.
Thank you very much, Nerida, and thank you, NAR, for hosting this and for giving me the opportunity. One of the things about foreign buyer activity in Canada is we have a bit of a data problem, so we don't track it very well. And so it's sort of a mix of what Nerida was just saying, is that we don't have a lot of restrictions on foreign buyers right now. It's often used as a bit of a political boogeyman, and I'll come back to that at the end. I think to begin with, I'd like to just do a quick overview of what's going on in the market, how we came into COVID, what happened during COVID, and what to maybe expect coming out of it. I've learned my lesson in the past from following US and Australian presentations, because of course what's going on in Canada is very similar. So I'm going to try to focus on things that are a little bit different. I like to keep things simple, and I think that the biggest driver of what's going on in Canadian housing markets right now is domestic demand. But that domestic demand is coming from new Canadians who are arriving via international immigration. And we've spent a lot of time in the country bickering about whether or not to, the political parties want to stimulate demand to help millennial buyers, but they also are worried about financial stability. So we've got a stress test that forces you to qualify for a mortgage at a much higher rate than you're actually getting. That was controversial. But ultimately, while all that was going on, there's suggestions about tax policy changes. What the big demand stimulative policy change that happened was around 2016. We had a massive increase to our international immigration targets. So you can see with my red line there, this is quarterly seasonally adjusted net international immigration to Canada. Huge increase. I mean, from 60,000 or so a quarter to just before COVID, 120, 130, 140, that's double. That's a big deal. And so where do we go from here? You can see that we had a break during COVID briefly, and it's already coming back quite strongly. And now all of our population growth comes from international immigration in Canada, and this is the annual population change year over year. The numbers may not look big compared to the US, but this is 50 years of data. 325,000 increase a year was pretty standard. And just before COVID, we were into the 500s. That's a 40% increase in the households coming in. And we're still operating on some of these old rules of thumb about how many units to build. And over and above that, you've got the millennials under there who are all gone from their 20s to their 30s, immigration filling that same demographic space. and the units we're building are increasingly high-rise condos. And so we've got a mismatch of housing stock to people, and probably a shortage of housing stock as well. It's been one of our big advocacy asks is let's do something about, let's stop talking about tinkering with demand policies and start building more homes if we're going to have record population growth as far as the eye can see. And I believe that is the plan coming out of COVID. So what happens when you've got all these millennials and new Canadians that are buying their first homes? People who buy first homes in the ownership space absorb inventory. They don't put a unit back on. And so this is the overall number of active listings on every MLS system in Canada at the end of every month, seasonally adjusted over 25 years. And we are currently at an all-time low. That's with a record population, record housing stock, but a record low number of those for sale amid record demand for those. And that's how you get 10 and 15 and 20 offers on these places. And the price growth that I'm going to show you has been happening in a moment. What I find interesting about this chart is to point out when COVID happened. And most time series charts of data, it's pretty obvious when COVID happened. But on this one, we just kept trucking along. This trend was well underway before COVID. It was a problem before COVID. It's going to be a problem after it, more so, as you can see. And if anything, all that happened was COVID caused a bunch of people to take their homes off the market because they didn't want to sell during a pandemic. Now, that might benefit us a year from now if some of those sellers come back. But the other thing that happened was sales were so strong that it just kept drawing that inventory number down. How strong were they? Well, it looks, and of course, that's our record low now. This is seasonally adjusted sales activity on an annualized basis. Very similar to the chart that Dr. Yun showed for the US. We had a brief, we had pretty steady sales of about 500,000 a year for a decade heading into this, a 2-month lockdown where everything stopped, and then a massive rebound where we were hitting numbers that I just would have never thought possible. From 500 to 600 to 700 to 800,000 plus annualized sales in March. Now, as you can see, that number has come off a little bit. We're here currently as of June, but that's still above basically everything else in history. And so from red hot before COVID to white hot during, back to red hot again, this is not a Goldilocks market. And that's with that international immigration piece having not come back yet, as it's likely to do any time now. So this is another chart that Dr. Yun showed, and the Canadian context is very similar. That's the number of months of inventory, overall inventory divided by sales on a monthly basis. And you can see, as I was saying before, from 2015 to 2020, we were watching this move from a buyer's market to a seller's market. So we were going to have a year of double-digit price growth in 2020, no matter what. We were calling for it back in 2019. But obviously those double digits have been a lot larger because of COVID, as Narrative pointed out, and I've used this term many times. COVID turbocharged a lot of trends that were already there, and just supercharged them. Coming out of COVID, we've got to think about how many of them are still going to be hanging around, maybe just not as extreme. Of course, you can see where we are today. Almost off the charts in terms of how tight market conditions are, and everyone sort of has an incentive to say, oh, things are finally cooling off on their own. But boy, that's a long way to go, even to get back to a regular seller's market with 10% price growth year over year. And where we are now, as I'll show you in a moment, is more like 25% year over year in Canada. But I want to break this out regionally a little bit. I know that's hard to do in a short time frame. This is just the Canadian months of inventory, how we measure a buyer's or a seller's market from west to east by province. On the far left, that dark blue bar is Canada overall. And this is actually in February 2020. So I just want to set the stage of what things look like before COVID, where, most of central Canada and the eastern part of Canada, the maritime provinces, Ontario and Quebec, and increasingly British Columbia, a lot of the big provinces were already into seller's market territory or very close. Nationally, we were very close to, flashing red as a national seller's market for the first time. The last time we'd gone down into a seller's market like that was 2002. And so it'd been a very long time since we'd seen a market condition like that. Obviously, those ones that are way up in buyer's market territory, that's the oil patch in Canada. A lot of inventory overhang, places not selling since the oil patch. But if you look now at June 2021, everywhere has tightened in the wake of COVID. Supply is down everywhere. Sales are up everywhere. The synchronous movement regionally has been amazing. Even those places that were buyers markets are now seeing 10% price growth. And that's the smallest in Canada. But these are places where prices have been falling for 5 years following the oil price collapse. So this has really been a synchronous, massive tightening of the market across Canada. And you know, how do you achieve big sales numbers like that? Well, a lot of people are just moving around because of COVID. But people who've owned their homes for 20 years, who weren't going anywhere, who suddenly moved, have a lot of equity to play with. And that's one of the reasons we've been able to see some of the competition and you know, some of the price growth we have. This is our MLS home price index, we're very proud of. Covers almost all of Canada now. We also seasonally adjust it with our national stats agency. And you can see that in the last year, we're up 25% nationally, which is completely off the charts. It's never happened before. But similar to what we've already seen in the previous presentations. But if I can break it out regionally, there's a point that that was made in one of the previous presentations that I'd like to key on here. And I realize this is a bit of a messy chart. Don't try to read it. Again, it's west to east, all of the markets that we cover with this index. On the far left, that's British Columbia out on the west coast. Those lower bars are the oil patch. Like I said, you know, 10% price growth in places where prices have been falling for 5 years. And then those ones that are up around 40, 50, 60% year over year, that's in Ontario, where I live, where we don't talk about months of inventory, we talk about weeks of inventory. But what's really interesting is if I highlight two bars here, these two red bars, that's Vancouver and Toronto. And so historically, what you would have seen is Vancouver and Toronto leading the charge here. These were the really worrisome cities where prices were just out of control. And in the COVID era, what's happening is they're dragging way behind some of these other nearby markets that are outside of that commuter ring. Why is that? Well, big cities, people didn't want to be in big cities. They're already expensive, so less scope for price growth. Lots of condo apartments that weren't so popular up until recently. And meanwhile, these other places, where are they? They're far away. They're where we go on vacation. It's where there's oceans, mountains, skiing, and lakes, cottages, rivers, places you want to be if you don't have to be near a building you don't commute to anymore. And so part of it's that, part of it is just the fact that we haven't been able to travel anywhere else. And so vacation areas within the country have been very popular. And a lot of scope for price growth too. If you sell a home for $2 million in Toronto and go up north to cottage country, it's easy to bid a $700,000 cottage up to, you know, 1.2 or whatever it takes to get it in the midst of a pandemic. Now, more recently, the conversation has turned to the supply side and the idea that we've underbuilt for our population. Like I say, it's not just the population growth, but also the millennial demographics underneath that. You know, we've been building all kinds of condo apartments, not nearly enough, and nobody wants them. I think that probably that trend was in play beforehand, just with an aging population. But certainly COVID is one more thing that's one more reason to turbocharge that trend over and above, you know, turning 30 and having kids and all the rest of it. So just to wrap it up here, this is our Deputy Prime Minister and Minister of Finance, who's recently said, you know what, we get it. It's a supply problem. We need to figure out a way to build more. We're the federal government. We have levers that control the demand side, and municipalities control zoning and all that. So how do we link those things together? How do we get these government agency levels of government to cooperate to get more housing built? The missing middle. You know, in 46, everyone came back from the war and we built homes for the returning vets. In the 70s and 80s, we made the suburbs for the baby boomers. We now have another housing crisis. We've been calling it the missing middle for 10 years. I would think we'd just be calling it medium density housing by this point, but it's still missing. Now, for anyone that doesn't know, there is going to be a federal election called in Canada, probably within the next 2 weeks. And so in August and September, this is going to be a major policy issue in this election, with the federal government courting the big block of millennial voters who are all very frustrated at how expensive and difficult it is to buy a home. And so I guess I'll leave my presentation there. I hope I didn't go over time. And for the closing remarks, I'm going to throw it over to Bob Goldberg, who is the CEO of the National Association of Realtors.
Our CEO, Bob Goldberg.
Well, thank you, Sean. And I really want to in close, thank all of our great panelists today. Wonderful information for sure. And certainly all the participants. There were nearly 2,000 of you engaged real time on this. And these sessions that we've been doing over the last 3 years, mainly live, certainly before the pandemic, certainly help give a gauge as to what's happening not only in the United States, but different worldwide data points. Clearly, real estate is a driver, certainly of the economies around the world. I'll give you one data point that I always find very interesting. You know, after the pandemic, and I shouldn't say after, but certainly as we're coming through this tube of this horrific time period over the last year and a half, still not out of the woods yet, but NAR reached an all-time high in membership, which is not what we predicted a year ago, March. So our membership just topped 1.5 million members, by far our largest ever. What's really an interesting data point is that there's only about 1.25 million active listings in the United States. So there are more of our members trying to sell inventory than there is inventory out there. It just plays as to like what you just heard Sean and all of our panelists saying today, that you know, that's a key driver as to why there's multiple offers of properties, low inventory, not enough building, record low interest rates, all of that contributing. And we see that still somewhat happening in the near term. I want to also thank NAR's leadership team, our president, Charlie Oppler, who you saw at the beginning of this session, and all of our great staff under Dr. Lawrence Yoon and Dr. Jessica Lautz from the NAR research team, working hard really with all of our counterparts around the world to put these sessions together, and I want to thank them. You know, as we come through this, and I referenced it before, I think what we've really entered into is what I call the now normal. It is no longer the new normal. It is what we're going to be living with, where there'll be a combination of live events, virtual events, and it will therefore engage more people and more participants than all of us have experienced before. And that's a good thing. That's the silver lining that's coming out of this. More people participating. We hope that you will consider, NAR has some pretty significant events coming up. In August, we have our Innovation Opportunity Investment Summit. It's a high-tech summit with startup companies from all around the world. It's a global event that will be held in Dallas. The exact date will be on August 17th and 18th, with billions of dollars of technology investors there in the prop tech sector. So a great place to be. Our C5 Summit, it is a commercial real estate summit, again, where deals can be made. It will be held in New York City live, September 27th through the 29th at the Marriott Marquis, and certainly the NAR annual conference and convention that will be in San Diego live November 12th through the 14th. All of these meetings that are in person will also have a virtual component for those that can't make it. You can certainly go to nar.realtor to find out more specifics on any of those. But again, we want to thank all of you for your participation and look forward to joining us either live or in a virtual event coming soon. Thank you, everyone.